Good afternoon, good morning, good evening, depending on your time zone. I want to thank you all for coming to our panel discussion, provocatively titled, Has Biotech Peaked? On the heels of the publication of Locust Walk's latest quarterly market conditions, we're joined by a great panel of experts to help us unpack the trends in the industry as Q3 ended and we sail into the end of the year. We have 1 hour allotted for the panel, including questions that we have prepared in advance, as well as questions received in advance from participants. If you have any questions you'd like the panelists to address, please submit them through the Q&A system, and I'll read out the most frequently asked questions and ones that have the broadest applicability to the audience, interspersed or at the end. If we do not have time to address your question, we will follow up shortly afterwards with our thoughts. We are recording this, and a playback will be available shortly afterwards for all attendees and registrants. We will be, I guess I'm also obliged to share that due to confidentiality obligations and other regulatory requirements, we will not address questions specific to any one company unless any of the panelists want to talk about something that they're involved with. This is also, for Rachel's benefit, not considered legal advice, or for Anurag's or mine, an offer to buy or sell any security. Everything is off the record, but something that you're welcome to attribute more broadly to the conversation. So, to set the stage for the panel, a little background: biotech offerings and private financings, they've certainly slowed down in the third quarter, especially in August and September. I think we've seen that continuing in October and November, where there have been financings, but there are indications that confidential filings are being pulled or delayed. It's more challenging to take companies public. The crossovers are getting more difficult to get done, and especially the very early companies, they're suffering the most, unless, of course, they're backed by the absolute top tier of investors. SPACs have also cooled off, with few to no new issuances of recent from fundamental life science investors. And I think we've also settled into a steady state of deSPAC announcements and new pricings, which signals that unless volume of deSPACs picks up, then there might be some SPACs that do not find their targets. Not all gloom and doom. On the plus side, M&A has picked up, with a few deals announced in the last quarter, including in the last few months in the fourth quarter. So then the question is the M&A bid making a comeback? Will financings resume their pace like we've seen, or are we stalling out? To dive deeper into these trends, I want to thank the panelists who have joined this discussion, and I will introduce them each briefly. So, Catherine Breedis is a biotech CFO consultant with Danforth Advisors, and she has many years of experience, which I will not name, within the biotech industry, capital markets, corporate finance, merchant banking. She's been in BD and corporate strategy at Lilly and Pfizer, and has a Wall Street background, served as a senior analyst on both the sell side at Stifel and Goldman Sachs and the buy side at Schroders and Citigroup Asset Management. Catherine is a CFA and a chartered market technician, which I think she was doing some stock trading behind her shoulder, as I saw before starting this conversation. So welcome, Catherine. Rachael Bushey is a partner and chair of the Health Sciences Department and a member of the firm's management team and policy committee at Troutman Pepper. She represents public and private life science companies in connection with a variety of capital markets deals and complex corporate transactions. Rachael has significant experience negotiating deals with pharma and biotech in the US, Europe, and Asia. Welcome, Rachael. And last and certainly not least is Dr. Anurag Jindal. He made me remind him that he was a real doctor once upon a time, although now he's more a doctor of the markets. He's a senior managing director in investment banking at SVB Leerink, where he joined about 6 months ago. He covers the biopharma sector. He has over 2 decades of experience in biotech, including 16 years of prior banking at JP Morgan and most recently at Bank of America, as well as in strategy M&A roles at Novartis in Switzerland. So welcome, Anurag. So everyone, appreciate you joining. Let us dive in. So I'll call out who's gonna answer, but feel free to step in if you have any perspectives that you want to share. I guess I'll just start out by talking high level. What have you seen in the markets that is a cause for concern and also a hope for the future? So Rachel, you're at the top left of my screen, so I'm going to start with you.
Fantastic, thanks. So as you noted, Geoff, obviously the slowdown in the market, the choppiness, the unevenness has given everybody a cause for concern and has caused a lot. We've seen a lot more delays of IPOs in the third quarter, as well as withdrawals. In the first 6 months, we really were excited to see, companies getting out. It felt like left and right, even companies that perhaps we were surprised to see get out. And we're seeing definitely a slowdown of that. Hope is absolutely not lost, though. There is still a lot of dry powder available, and there's a lot of exciting new therapies and innovative technologies. And I think as long as that continues to exist, we will see a lot more companies still going public and tapping into the capital markets. I think we're going to see a little bit more of a return to the rigor around the types of companies and a focus on the investors that are in the companies leading into the IPO.
So Catherine, how do you think about what's causing us some concern? What is the hope for the future?
Sure. Well, I think we're really at a point of pause in the market. You have to look at it in the context over a long period of time. And we are, I think, the longest bull market for biotech new issuance that I've seen in my career, and that we've seen, I think, in over a decade. We've had 45 straight quarters of biotech new issuance. We will probably be on track to have a record year again when you consider not only new issuance through IPO, but also follow-ons and venture offerings. And that, in the context of the sector, I think is a very strong setup for further momentum in the coming year. And I look at really two fundamental factors. One, the science remains very strong. We're not seeing any increase in pipeline failures or delays. And secondly, the regulatory environment is very strong. And I think with the appointment of Dr. Robert Califf as FDA commissioner, really for his second time, going back to his first appointment in the last year of the Obama administration, I think is a favorable setup.
So Anurag, I guess the follow-up to what Catherine just said is, she has some bullishness about next year. And so the panel's titled, "Has Biotech Peaked?" So is there real cause for concern with storm clouds, or do you think that we're going to resume our march in the first quarter of next year?
No, thanks, Geoff. And I agree with Rachel and Catherine's commentary. I think what gives me hope is obviously 2020 was quite a record year for capital formation. And we've, in some ways, regressed, perhaps not quite to the mean, below the mean. But as Catherine pointed out, I think we're continuing to be in a general bull market for biotech. I don't think historically we've seen two back-to-back bad years for biotech. So that does give me hope that we will kind of regress back to the mean, perhaps not 2020. So it feels like the irrational exuberance that existed in 2020, partly because of a COVID trade, right? Which was in effect in 2020, and this year, kind of the COVID reopening trade not working in our favor in terms of biotech, really wreaking havoc on the markets. So I think that gives me reason for optimism for next year. I think, again, as Catherine mentioned, the fundamentals are quite strong. What has been interesting this year is, despite no wholesale fundamental negative shifts from a clinical and a regulatory perspective, the market has been, I'd say, not willing to give companies the benefit of the doubt on data readouts, right? Markets have tended to react quite punitively to stocks, to companies on data readouts, unless the data readout exceeds expectations, right? Meeting, certainly underperforming expectations, it does not lead to success, but even meeting expectations around a data readout has been challenged in the market. You've seen it take place even just over the last couple of days in the gene therapy sector with Regenix and Rocket data readouts. So I'm hopeful that as new technologies continue to emerge, continue to generate positive data, sometimes incremental, the market will start rewarding those companies for continuing to push the needle in the right direction.
Yeah, it's interesting to see what's in favor, what's out of favor. Things cycle out of AAV and goes into gene editing, and things are almost like a pendulum. I guess the follow-up question to that is, if pricings are getting more challenging and the indices are mixed at best to down, and there are brand name investors in biotech who are down for the year. How do we think about that? Does that impact desire to put new capital into a new company or just support their current companies? Does that affect new issuance? I mean, there's got to be some fundamental impact that has. And Anurag, if you want to just keep going there, then I can pass that on.
Yeah, absolutely. No, it has and it hasn't, Geoff. And it's so cyclical and it's so timely in terms of which investors are in favor of biotech and out of favor right now. And I think what we've seen over the last couple of years is the explosion of mid-cap companies. I think there's over 200 mid-cap companies kind of in the $500 to $5 billion market cap range. And the value of those companies has gone up to some massive number relative to a couple of years ago. But what's gone on along with that is the emergence of a roster of funds that are dedicated to healthcare and dedicated specifically to biotech that now have tremendous amounts of capital. So it's not just the Fidelities, the Wellingtons, the T. Rowe's of the world that can put meaningful amount of capital into these mid-cap companies. It's the likes of RA, RTW, Perceptive, BVF, Cormorant, right? The list goes on. And I think one of the pieces of advice, I think historically we've always been asked, clients will always ask us, how do we get into the long-only mutual fund complexes? They serve a purpose, but increasingly over the last couple of years, the dedicated investor community has played just as equal of an important part, especially as we think about private financings, especially as we think about starting out as a small cap or a mid cap company. It's really when you get to a size of $5, $6, $7, $8 billion in market cap, where you really need to be able to access those larger pools of capital that live in the mutual fund complexes. But that part of the ecosystem is just as important to pay attention to.
Got it. So just if I could summarize that, it sounds like the capital markets for biotech for the smaller companies has evolved to a point where there's enough capital to be self-sustaining for those companies, and you don't need as much of the generalist bid to prop that up. It's only when it gets to a certain size that becomes more important. Is that fair?
Yeah, exactly right. Right. But I think if you look at the private capital formation, Geoff, the trends are quite encouraging in terms of how many private rounds or crossover rounds have been done this year relative to historical levels. And that gives me, again, optimism for what 2022 will look like. We expect a flurry of activity from an IPO perspective. We're on record pace, I think, as Catherine alluded to, from an IPO perspective this year. The follow-on market has been quite challenged in biotech. And what you've seen is the preponderance of activity has really been catalyst driven. The cost of capital to access the markets for an opportunistic financing is quite high, and you're seeing high teens, 20% filed offer discounts for those types of offerings. But catalyst-driven financings are high single-digit, 10%-ish from a filed offer perspective, and there's been a number of recent examples of those deals going quite well. So again, I think that irrational exuberance, that reality is somewhat setting in. I think it suggests somewhat of a healthier market, where the bar is high and the filters are appropriately getting right-sized. Now, how we swung a little bit too far, perhaps, and perhaps 2022 is when things get right-sized again.
Got it. Rachel, I know you wanted to jump in. Go for it. Yeah.
Yeah, sorry. One of the things I was going to say on that, Anurag, is that I completely agree. But in this last quarter here, we are seeing difficulty with even what I would consider high-value companies with the blue chip investors getting crossovers done. We've seen such a huge delay in the ability for companies to get that lead. We have it seems a lot of investors are talking about, yes, we would participate, but we don't want to lead. And just compared to the first two quarters, I guess, how do you think about that? And is that consistent with what you're seeing as well? And you and
Absolutely. I think some of it's also given the level of activity this year, chips that have already been placed in the market by a lot of these funds. In some ways, they're waiting for a reset of the calendar, and deals that are trying to close in December are very hard pressed to do so. And people are asking for just that extra month even to get into 2022.
It seems like burnout is also high. We're hearing it's been such a crazy year for everybody that it seems that if you're not already kind of ready, geared up in your IPO, it's the rest of the piece. If you're kind of trying to go out in January, it just seems slower than expected.
And the bandwidth of investors is more difficult. It's harder to capture mind share. They have a lot of choices now, and we've seen as well a ratcheting up of pre-money valuations that I think has also raised the bar in terms of execution and also interest. There are more companies at an earlier stage who are able to raise capital, and there are more companies that are well capitalized heading into an IPO market. So I think that also is creating a setup of really a tale of two cities, where we have some companies who are underfunded and some who are well funded and able to maybe take a pause and step back. And that, I think, is adding to the dynamic and what we're seeing in terms of a slowdown.
Catherine, I think one thing that you said there, it actually, really rings true with me, which is we used to see crossovers and then some kind of a data inflection point or something happening new with the company in order to have the step up pre-IPO, or, have some kind of step up prior to the crossover through some kind of data or something new with the company. What we've seen a lot this year is the step ups in valuations with no new data, nothing new with the company. And so I think you are seeing valuations increase and then increase, I don't want to say artificially, but just without what we would typically consider some kind of a catalyst.
Well, so I guess the question that the panel is hoping to address is that sustainable? I think, Anurag, you started to hint that it wasn't. And we have heard, maybe Rachael, you and Anurag can comment on how deals are getting done. You did hint, Rachael, that it's getting more challenging to find a lead, but are people pulling their offerings? Are people struggling to get the valuations that they wanted? Talk a little bit more about what you're seeing from your clients in the marketplace and the day-to-day hand-to-hand combat versus the overall macro trends. You're on mute. Oh, there you go.
Sorry. Sure. So what we're seeing right now, so in terms of IPOs, are that if the company is in this last quarter trying to do a crossover, they're still going to get it done, but it is slower. And their IPOs have pushed from early January to later, especially when you have to consider the staleness of the financials. There's a limited window there. And so it's just pushing things into a little bit later. In terms of follow-ons, I completely agree with Anurag. We are seeing not a lot of good follow-ons getting done. We're seeing a lot of people gather with banks, talk about it, and then end up pulling or not going forward because they're frankly sticker shocked on the discount that they're going to have to take.
Geoff, one of the interesting things we're seeing, you've seen it exemplified by at least one deal in the market, is the notion of a top-off round. So I think to the point you were making earlier about step-ups, or Rachael, you were making around taking a step up from a crossover to an IPO and not having nothing happening. We're also seeing now a new round get inserted between a presumed crossover into the IPO, in many cases without anything material even happening between those two events. And it's frankly something we're discussing with a number of clients that we're working with on an IPO right now, where they've done a high quality crossover. I think this notion of overfunding your business, building a fortress balance sheet to the extent you're able to, suddenly becomes all the more important. It was a trend we saw in 2019 and 2020. I think to the point I made earlier around data sets being difficult to be recognized unless they exceed expectations for platform companies planning for an IPO and thinking about fundraising off the back of that initial data readout. That's a playbook that seems to be very stressed and challenged in this market, given in many cases a small sample set of patients and a short duration of trial treatment and the market not responding well. So overfunding as a private company, even with a higher cost of capital and into the IPO itself, perhaps is kind of the new playbook here.
So I want to go to Catherine in 1 second about that specifically, but it's the reason I'm smiling is that's called a Series B. A Series B is a crossover, at least it never used to be, but if you're saying they need a top-off round, that sounds an awful lot like a B to me, or that previous round is the B, then that becomes the crossover. Is that fair? You can just shake your head. Yeah, I got it. So Catherine, I mean, I guess working inside of one or more companies, how do you see that investor receptivity and the challenge of getting that, or the need to get a top-off round? Maybe just speak to some of what Anurag said.
Well, I think that, companies are going out earlier. That's another key point to mention, is we're seeing, a larger number of IPOs with companies that are preclinical or in phase one, which sets a higher bar in terms, and a higher risk in terms of probability of technical success to have a favorable readout. So that that raises the bar on top of a higher valuation setup. The other piece is execution, because a lot of the time these younger companies don't have the infrastructure or the planning ahead to manage the news flow over the next 12 to 24 months. So that's one thing that we try to guide with our companies, is to be prepared to be a public company, because it's not just being public, but it's what you continue to do. And this, I know, resonates a lot to what Rachael does every day, is being prepared to manage that news flow and to be prepared for data readouts, however the outcome may be, because they're generally binary, and to continue to cultivate that investor base even after you go public, because that becomes of increasing importance, even if you IPO with a strong, crossover syndicate at hand. I think the other piece that's happening behind the scenes is, and this may affect volume in the early part of next year, is that auditors are faced with also issues in terms of processing audits for new companies that want to go public. And we're seeing timelines for companies getting pushed out if they haven't already put that on the schedule into it sometimes, mid 2022 or third quarter of 2022.
Wow.
So those are some other dynamics to keep in mind.
So you actually started to answer my next question, but maybe I'll stay with you then just to embellish on it. So for companies that are considering that financing, whether it's a crossover or they want to get public, or frankly, their A, or even their follow-on, just what would you advise in this market that maybe you'd say is a little different than in the past? And how could we give some practical advice to the audience about how to think about their next financing?
Sure. Well, I think being patient is important, right? I mean, that's not a new theme. That's always been the theme. And being mindful of your cash burn, because many companies are well-funded today, but you need to be prepared for a rainy day and know if the market conditions, as we have now, are pushing you into the first quarter of next year, that doesn't really impact your runway or put you in a position of making tough choices. I think what we're seeing with a number of the companies that have postponed or pulled offerings is that they want to wait. And if you have the ability to do that, it generally makes the most sense. I think the other piece to be mindful of is that you only get one chance to make a first impression. So going out at the right time with the right storyboard that will differentiate among a very crowded landscape of other investment alternatives is really important.
Rachael, do you want to go next?
Sure. So Catherine, I could not agree with you more on all of your points. I think, one of the things that we see sometimes companies do is they cut it too close between their cash runway and when they expect to go public, and they don't have enough time to recognize for delay, whether it's, delay in the financials, SEC comments, any kind of delay in the market, and they get themselves to cash crunch. So number one, I really think make sure you have enough cash to last you through what you expect to be a much longer process than you're currently anticipating. The other thing that we saw this year was, because in the beginning of the year, it was easier to get out to be public. We saw some companies, while you had a lot of great IPOs that had really blue chip investors and fantastic crossovers, we saw another segment of companies skip past that and think that, being public, the capital is easier to get it, and let's just go public and we'll worry about our cash runway, once we're public, et cetera. You have to be really careful with that strategy. There's all kinds of rules once you're public about, baby shelf, and you're constrained on that. You have the NASDAQ, 20% rule. You can't file an S3, so a shelf registration statement for a year after you're public. So there's a lot of different concerns that you need to think about in that first year for fundraising. It's certainly challenged. And you need to think through your financing strategy, as Catherine said, because of the fact that even if you do have good data and, you may not be able to get the money that you want to get. So think about your life beyond the IPO and just getting to the IPO. I think also listen to the bankers and the advisors when they're talking to you about why they're having a hard time getting your crossover done or your Series B, and why it might be a challenge for you. Sometimes clients tend to think that they don't hear the advice and they don't want the advice, so they go and pivot. And at a certain point, you have to recognize what the market is telling you and what it's going to be like. And just getting to that first step isn't always, it's not the end of the road for sure. And you need to be prepared for beyond. So really listening to, I think, your advisors in terms of the market, the choppiness, and how they view your company. Like anything else, we tend to love what we're working on. We tend to love our companies, but we aren't always objective. And you've got to hear the advice that sometimes you don't want to hear because it'll be better from the company in the long run.
So Anurag, any thoughts? And I have a follow-up on that about the direct IPO, but why don't you see if you
I would perhaps say just a little bit differently. I think it's generally thematically aligned with what Catherine and Rachel said. I would say take the money when you can, right? If it presents itself, because of all of these themes that we just talked through. You don't know what the market's going to look like. This is drug development or commercialization. You don't know when it's going to be available based on market conditions. So if the opportunity presents itself at a reasonable cost of capital, I'm not saying dislocate the company, take as much as you can get.
So yeah, it's usually good advice. And I'm going to follow up on something you said, Rachel, that we didn't talk about in the prep for this, but I've seen more and more companies being advised by some set of the banking world about doing direct to IPO, which shockingly was how the world used to work. This whole idea of a crossover requiring 80, 90, 100% coverage of your IPO from insiders wasn't the way things used to happen. Now it's a more recent phenomenon, and some more aggressive banks are, I guess maybe to get better position on the cover, are saying, yeah, we can take you public and you don't need to do that crossover, which is extra dilution, which certainly impacts, Rachel, what you're saying, what is your future capital raising plan, but you're then public, maybe you can do a pipe, maybe there's other things that you can do. I'm curious if any of the three of you have seen or recommended that, or how to advise a company to think through, quote, skipping the crossover, or maybe you had a couple crossover investors in your round and that's enough. You don't need to do another formal crossover round with further dilution.
I think it depends who's in your syndicate. And that will shape how you think about next steps. It depends on the relationships that your syndicate have with crossover investors, and really how strong your story will resonate relative to your peer group, and overall what the investment thesis is going to be of moving forward in your stock. I think that sometimes investors lose sight of the fact that, or rather companies lose sight of the fact that they need to prove themselves to investors every day once they're a public company, and having that storyboard in mind and knowing how you will compare relative to others makes a big difference. So you don't have to have a crossover, but I would strongly advise for one if you can pursue that avenue.
Geoff, I think in this market, IPOs are heavily concentrated to the top 10, top 20 orders in the book. They tend to be heavily skewed towards existing investors. I think from our firm's perspective, we are very hesitant to recommend launching a deal that's not covered because we're seeing such little general new investor participation. I think you can generally count on one or two investors coming in. It's often difficult to identify who that's going to be. So you don't want to go out on a wing and a prayer. And so perhaps, again, circumstances can be individual to a company that would allow for that setup, but I would say that's probably few and far between that would allow you to get public without really strong insider support on the IPO.
So let me push you on that. So what if you were to do a testing the waters series of meetings while you're still confidential, see if you can get the book covered from that, and then either pull the trigger or convert that into a top off round, to use your terminology?
Yeah, no, and absolutely. And that can be an important insight that we gain through a TTW process. You know, I on a scale, I'll state the obvious, right? Having interest expressed as part of a TTW process is very different than having an insider who came in on your last round, knowing that you're good for that individual to participate. Things can happen in the market over the course of 2 weeks, specific to your story, to the market, or in their portfolio that could change that perspective. So it's just not as confidence generating as an insider investor.
It's interesting because a lot of times companies, you're right, a few years ago, you didn't need the crossovers. Now everyone is advising for them, and most most quality IPOs have them. But it's a delicate balance when you're advising the companies that they feel they have enough capital, they have a good inside support base, insiders, and they don't want to take the dilution before the IPO. And so I, along with obviously the bankers, you always have to remind them that this a lot of times is like generating fear of missing out, right? It's building the quality of the book and the strength so that when you're going to price the IPO, you're not pricing it from a position of weakness, but a position of strength. And while if you take the dilution now, as much as it's hard to swallow, you are going to likely end up pricing much better. You'll end up trading better. And so there are these benefits. And I think sometimes it's really trying to spend the time with the companies to connect those dots because they aren't thinking about that next step because they haven't been sitting in some of those pricing calls that we've all been in. That's like, oh God, this isn't going well. And they've already spent all the money. They never thought they'd end up there. And at this point, they don't have a choice and they're going to take it. So we've all sat in on those. And we've also sat in on the ones where everybody's high-fiving and, we're having to turn away all these quality investors. And so it's getting them to realize there is an art to it. It's not just luck.
Yeah, no, that makes sense. And I appreciate you addressing that because it's something we're hearing more and more from companies. Ironically, it's the exact opposite advice I think that you're giving is to do the top off round, get more people in privately, as opposed to skipping that altogether. Don't do a crossover, go direct. And some have been successful, but it's not necessarily as easy. And maybe with some second tier banks, you want to be more aggressive. So for what that's worth. Before we move on, I guess I'm still hearing a lot of bullishness from you, which is great. My goal was not to have a dour, sky is falling type of a panel, although we do want to reflect the reality of the situation so people can best prepare. So if 2022 is going to be a resumption of the pace that we've been on in 2021, when is the top? I mean, how do we call it? I guess some data that I've seen is the pricing of a lot of the offerings that was at the top or above the range in the first quarter was, I think it was 68% as opposed to 26% at the top or above the range in the third quarter. So we're seeing pricing come down, be more rational or more nuanced. And so what is really causing that? Is it the generalists, which Anurag, you said isn't as big of a concern, or is it the specialists just getting tired and burnt out and they have too much paper, too much product that they have to invest in, so they're getting more discerning? How does that play out in 2022?
I think it's a reflection of the already existing public companies, right? Given the underperformance in biotech, whether it's the NBI or the XBI being the worst sector across all industries in Americas, it's a reflection of public company valuations that translates to how IPOs get priced, because you're naturally looking at IPO comparables when you're pricing an IPO, but you're also looking at trading comparables where a peer set is trading today, taking some type of discount. And as those trading comps are coming down, obviously that's going to reflect in your IPO valuation.
Anything, Rachel or Catherine, you want to add to that?
Well, further to Anurag's point, we're seeing that, the class of 2021, only 45% of those stocks are trading above their IPO price, and the class of 2020 had much better performance. I guess it's like in the 60% range, which is more the historic average. So that's something to be mindful of, is that valuations have come up, but we may have to consider that going forward and reset on expectations.
So actually, there was an interesting question that's related that just came in, and the question was around what is the pricing power that these crossovers have? If everyone's being advised to do a crossover, and there's, call it 20 investors that are leading those that are considered blue chip, are they really setting the tone for the entire biotech industry, or is there another path to go broader, where I would actually argue that capital markets are much broader and deeper now than they've ever been for biotech? And how do companies take advantage of that, or are they beholden to these 20 names who are really going to be setting the tone for what Wall Street is allowed to invest in? Funny, when you don't prepare the questions, you have to think about it a little more.
Well, You are seeing, I think the point I made earlier is as this mid-cap universe has expanded over the last couple of years, it has gone hand in hand with the breadth of the investor base expanding. But at the end of the day, we're not in a consumer or a consumer tech space, right? As much as retail has come in and you've seen funds like ARC really prop up the gene editing space, I think you're generally beholden to the institutional investors, and the thought leaders are kind of the ones that are going to have the pricing power here. And I guess the point you're making on valuation also ties back to the notion of having a deal effectively covered at the time of launch, because you don't want to price the deal based on the last marginal dollar coming in, right? You're taking back some of the control by having a book that's already covered, not relying on folks to be able to get it done. And that FOMO aspect that Rachel, I think, mentioned, playing to your favor because people know the deal's getting done. The other point I would maybe make, Geoff, unrelated, is I think in 2020, one could go into an IPO and think about potentially upsizing the deal, potentially pricing above the range. I think you go in now, the banks and the companies, with the collective mindset that you're launching in the range of where you think things are going to come out, and you should not plan on being able to take in any more proceeds than you're planning to launch. But it also goes back to a fundamental point that we often make with clients, is how do you actually define success? How does a board, how do the investors, how does a company and management team define success in an IPO process? Is it maximizing value? Is it bringing in new high quality investors? Is it bringing in the right amount of proceeds, if not more? Is it aftermarket performance, right? And you can push on each of those you can push on each of those different elements as much as you'd like, or you can find a Goldilocks scenario where you're trying to get the balance right across all those elements and really create what we call sustainable public currency to be able to have a company that people are going to track over kind of the short and midterm.
Interesting. Well, I for one, just to put my own opinion into it, I think that the capital markets are deeper, and I think that the gatekeeper status that a lot of these firms provide, it's still real, and there still is a strong element of that. But from what we've seen, there are ways of getting that capital in that could support you in an IPO. Maybe it's slightly non-traditional because you don't have the top names in your company beforehand. But I do think where there's capital coming in from family offices that now look like venture funds, from hedge funds that have a venture arm, from Asia that's getting the real credibility that they didn't used to have. I think there's more pockets of capital that could allow companies to have pricing power, to your point, Anurag, and maybe allow for them to take that next step without the validation. Maybe that's a little controversial, but at least that's what we're seeing.
That's right. And also the convergence of healthcare and technology, right?
Yep.
Technology firms, institutional investors moving more into healthcare. In many cases, it's tech-enabled healthcare, but often it's also the general concept of platform companies. And there's a tremendous amount of capital that you can access from those funds as well, to add to your point.
Cool. So switching gears maybe a little bit, one of the topics we wanted to cover was M&A and the impact that could or will have on biotech in 2022 as a potential positive. And so maybe, Rachel, I'll start with you, because you probably, given your perch atop the Troutman life science sector, have a view as to all the different things that are in various parts of a process. And so maybe if you have any perspective on the M&A bid, either reemerging or keeping the status quo, is it a little blip, or what do you see?
Sure. So I read a recent statistic that said the second quarter hit a 5-year low in terms of the number of transactions and the value of transactions in the biotech market, which I think just probably confirmed what we all were seeing ourselves in the market. I do think that the M&A market is starting to heat up more. There's certainly a lot more in the pipeline. It seems that there's a lot more transactions and discussions that are happening now. I think we're going to see more in the supply chain as folks try to consolidate their own supply chain and look at that as their biggest risk. I think that's where we will see some larger valuations and, some bigger deals getting done. I think, obviously, as hopefully COVID settles or slows and we have new promising pills that are coming out, that that kind of will help settle the M&A market, and we'll continue to see an uptick. So I think 2022 is going to be stronger than 2021 in the M&A front, just based upon what we're seeing in the pipeline too.
Interesting. Anurag or Catherine, any perspective you want to share?
I guess I would say, everybody's always looking at everybody. And what usually leads to a transaction are data or specific needs to add to a platform or to add to a commercial offering with a late stage asset. I think those will continue to be the driving factors towards M&A. And what we've seen also is that many companies are preferring to go to the public markets instead of doing a transaction and bypass that while they're at a private stage, with the objective of trying to generate more data and potentially increase the valuation. So I think that, those are dynamics that will continue to play. I don't think of M&A as being so much of a trend as a way that the pharma community looks at adding to their pipeline and commercial offerings. And it's the same things. It's data and it's value proposition to patients, payers, and investors that will drive deals.
I think the one other piece that I forgot to mention was just obviously the FTC. The FTC has come out and been, very much more aggressive, which I think has slowed down certain activity. We're seeing them not meet the timelines that they typically need to meet, or not giving the notifications in a timely fashion, which if you're public and you have to go out, for your shareholder vote and that risk is out there, it's, it can just continue to delay that. So I apologize, Anurag, I think you were going to jump in.
No, important point. Absolutely. I was going to say, maybe I don't have as dour of an opinion of 2021 from an M&A perspective. We haven't seen a large deal, a consolidation type of deal. But I think from a deal count perspective, we're generally in line with the pace that we saw in 2021. And I think to Rachel's point, there's a reason we're not seeing the consolidation. It's the FTC concern. What I think has been interesting on the larger company side, which factors into M&A, and I think gives me a reason to be optimistic, is the concept of shrink to grow has kind of reemerged itself, right? Moving away from diversification and big pharma divesting themselves of units or separating their businesses into pure play parts versus the conglomerate piece. And that will then allow them to focus on their therapeutics or their vaccines business, and sometimes they're in combination. And they have a huge need to continue to support the underlying growth of those. They're all sitting on tremendous amounts of cash that their shareholders are asking them to put to work, and clearly have a tremendous amount of access to capital as well. So I'm generally quite optimistic. I think the point Catherine made, science is always going to dictate more of the clinical stage or the preclinical stage deals that get done. You saw Sanofi go out and buy Translate and then shut down the COVID program. So clearly a platform play. I think there's going to continue to be the need to incorporate new additional tools into your armamentarium, whatever that be, whether that's mRNA or gene therapy or gene editing, and the convergence of cell and gene therapy is like what Bayer is doing. And then from a commercial asset perspective, I think we've seen an uptick in those types of businesses as well being taken out. It's tough to commercialize a product on your own, especially if you're a single product company, right? And with the financing markets being as challenging as they are, I think there's more and more of those conversations that are happening behind the scenes where folks are questioning whether their commercial business is sustainable because it's potentially under leveraged and potentially underfinanced. And I think there's going to be more deal making around those early launch stories.
I think the one takeaway though for companies, whether they're looking to get bought out once they launch or pre-launch or not, is they have to prepare like they will commercialize it themselves. Because if they don't, then the buyer knows that they're not going to be able to commercialize and uses that against them in terms of value, negotiation, et cetera. So, I think we've seen different schools of thought on whether, depending upon who the buyer is, whether they want to see them launch on their own and see if they can make it, versus another buyer who comes in and says, no, we know how to launch this much better than you do. And if you have a failed or a soft launch, it's going to only hurt the product, the reputation, and we're not as interested. So there's certainly different buyers and different schools of thought on that. But the piece of advice that I would always give to companies, and that is prepare like you will launch it on your own, because even if you do want to sell, you'll get a much better valuation.
Right?
Yeah, so
And further to Rachel's point on that, I would say that, one of the things that we always advise clients is to really start thinking about your pricing and market access strategy when you're in phase 2. If you wait, it's too late, and sometimes even earlier if you're in oncology. Know the value proposition and how you think about the addressable market and what your science can solve that is differentiated from the competitive landscape.
So,
and related to the preparatory comment that Rachel made is another one, which is processes, certainly public processes, have become much more narrow in scope and focus in terms of companies targeted. So it really behooves originators and smaller and target-like companies to make sure they're well socialized in terms of who knows what they're doing and what they're up to. So if something were to happen, they know who to call and they know where the options could be if they need to do a market check.
that's a great plug for a white paper we wrote about how to convert a license to an acquisition, where about 3/4 of all M&A deals started as licensing discussions. So I did not plant that, but I appreciate you giving that a shout out. I think the one thing that's interesting, I agree with everything you guys all said. I think the challenge, though, is that a lot of the companies that are going public are not those that are thinking of commercializing on their own phase 2 and beyond. There are things that are much earlier, and commercialization is kind of a faraway distant idea. And pharma company doesn't have a bid that can compete with those IPO stories. Usually the pharma bid comes in after some clinical data proof of concept, which is when the company is already public. So I guess, is there going to be a pharma bid for private companies in your view? Is that going to change, or is it going to be they're still going to go after clinical proof of concept? The companies have already gotten public, or does the IPO market reset to have things a little bit later, where there's maybe more tension between pharma and going public?
Geoff, I actually think there's a tremendous amount for looking at private companies. We're often told by pharma companies, don't even bring us the public names. We know them all. We track them. They're in our radar. Given the explosion of private company NewCo formation, they have a harder time keeping track of private companies. I think certainly from an absolute value perspective, clearly a private deal would be cheaper, right? Balancing risk, but they can also structure around risk. So I think there's a tremendous appetite, both from an absolute value and from structuring around risk, if it's the right scientific story and platform, perhaps not quite as de-risked as something already in the public markets.
Yeah, I think it's going to largely depend upon the therapeutic category, right? We've seen the gene editing and the cell and gene therapy companies going out so much earlier. So in those kind of hot areas, I feel like you're likely going to see it coming after public companies, but in perhaps other areas, see it more in the private space.
And fortunately as well, we're seeing a return to attending medical meetings in person. One of the silver linings of COVID is that we're able to have business development meetings through virtual, Zoom and other, WebEx formats, which have increased the number of stakeholders at a company that can come and have a discussion with a scientific team at a biotech company. So that's one positive. But I think the face-to-face meetings that are starting to return also will increasingly expand the spectrum of discussions and potentially be a catalyst for more deals going forward.
Yep. And one other thing to point out with Pfizer, Moderna, J&J, Lilly, Regeneron, and a few others who are making material revenue from COVID, they should have more capital to deploy somehow. And I imagine that wave hopefully will start to happen with that redeployment. You're shaking your head, so I assume that you're agreeing. Very controversial, of course. Very, very helpful. We did talk briefly in the intro remarks about SPACs. I'd be remiss if I didn't ask about that. It was the soup du jour earlier in the year, and now the soup is a little cold and maybe not as inviting. How are you thinking about the evolution of that market, and is there room in 2022 for a SPAC? I'll call it a comeback. Catherine, I don't know if you have a perspective you want to share first, and then Anurag.
Sure. I mean, as a firm, Danforth advised, I think we had 4 SPAC mergers over the course of 2021. And our pipeline is continuing to dialogue with companies that are exploring SPACs. So I think that there will be transactions over the course of next year. We feel very optimistic about that.
Geoff, I think it's a healthy maturation in the market, right? It's no longer two gals in a laptop or a rapper in his laptop taking a SPAC public, right? And I think that's necessary given the volume and the explosion of activity we've seen this year. At the end of the day, the SPAC is not a panacea. It has very similar characteristics to an IPO. I think the common mantra has been, you can get a higher valuation, you can get the deal done earlier relative to an IPO. I don't think that's necessarily true. I think just like an IPO process, you need to qualify the sponsor behind it, your ability to fundraise around it. Some of the benefits, I think, are probably more important for more financial driven stories and sectors where you have revenue and EBITDA and projections you can share in a SPAC process, unlike a traditional IPO process. Clearly in biotech, that's not the case for the vast majority of companies. We're sharing in a very fulsome detail our portfolio or technology in an IPO perspective, and there's really no advantage from a SPAC perspective. So I think you're going to see a quality shakeout. I think there are a number of SPACs out there that still are searching for business combinations. I think everyone needs to be pragmatic about valuation so that we can unlock this logjam and not continue to create this logjam in both SPAC IPOs and business combinations.
I guess I would say, and I've said this before, not all SPACs are created equal. I think you really need to diligence who the investor or sponsor are in the SPAC. I don't think we're going to see a return to the really hot SPAC market, so I'll go out on a limb. I think, it may not be as cold as it is now, but I think a couple of things. One, obviously the SEC is not a fan of them, has made it more difficult, which has made the process more lengthy. You tend to get more comments on a SPAC related transaction than you do in an IPO. So this common theme of it's always quicker than an IPO doesn't always bear fruit. It's not always true. And then secondly, we get back to what we talked about earlier about those pricing calls and having a banker sit there and help you through what the market looks like, how much to sell, how many shares, all the work that's being done there to help stabilize your trading after the IPO. You don't have that in a SPAC. And so there can be more volatility. Again, if you have quality investors and, you have certain things to offset it. Also analyst coverage. While, in an IPO, you tend to come out with, analysts initiating coverage. It's harder in the SPAC process because you don't have that syndicate. So I'm not against SPACs by any means. I just think that sometimes they've been sold as being more easy to get done and beneficial than a traditional IPO. And I think you have to really diligence the valuation and the investors and the sponsor before you get into it.
And also your advisor. So, and I would defer to Anurag to talk further about this, but having the right advisor who also can bring forward analyst research coverage after the SPAC is an important part of going public through a deSPAC process. And that we've seen has really been, it's filled a lot of the gaps that weren't covered in the past.
But a lot of companies don't necessarily hire a banker on their SPAC process, right? They don't want to spend the money. They don't. So I think it's exactly right, trying to get people to understand the value and the risk in that to make sure that they're making the right decisions so that process can be as valuable as possible.
And the biggest part on that is finding the advisor that can help you really think proactively to unlock and discover where the sticky shares could be and think creatively around managing those redemptions, right, Geoff? I think you're familiar with this. I also think what's interesting is historically we've always run dual tracks, right? Running a IPO process in parallel with an M&A. These days it's effectively a triple track in terms of adding in that SPAC conversation. And as I talked about this concept of a top-off round, it becomes even all the more interesting in those particular conversations where the company doesn't feel like they're maybe completely or adequately capitalized and are considering a top up. If you've already done a crossover, tends not to be as high on your radar, but if you're contemplating another round, it becomes all the more important to run effectively a triple track. Yeah.
And I have a lot to say, but unfortunately not able to do so from lots of internal regulatory reasons. So I'm going to have to refrain from being too verbose in this response. But in general, it sounds like there will be some continued SPAC issuance and deSPACs. It'll be a viable pathway that you all think will continue, but maybe not as hot as 2021, early 2021, and just kind of buyer beware with the right advisor, with the right SPAC partner. Is that a fair synopsis? Perfect. So we are running out of time. So I do want to give each of you kind of a 30 seconds to a minute just to sum up your views on where we are and where we're going in 2022. And it sounds like we haven't peaked, but just a little bit of your crystal ball would be great. And maybe Catherine, we'll start with you.
Sure. Well, as I said, I think the setup in terms of science and the regulatory environment is very favorable. We'll want to keep an eye on other policy factors, particularly as it may relate to drug pricing, which I know Rachael has also touched a bit upon. That's a factor to watch, as well as interest rates. Rising interest rates has never been something that we've thought about really for quite some time, but that can also be a negative headwind insofar as it has an impact on DCF valuations, which I don't think we're anywhere near being at that place. But if you look and turn back time to, 2016, that was something that we would have considered at that time. So overall, I think we're in a very favorable setup for the coming year.
Awesome. Dr. Jindal, do you want to go next?
Mom would be so proud. No, I agree with Catherine. I think we've all generally aligned around the level of optimism for 2022. I don't think I've ever been as excited about where we are from a scientific and technical perspective. And I'll state the point that we've all read over the last year and a half. I think the emergence of mRNA as a therapeutic modality and how quickly and importantly it was able to be factored in, leveraged into a multiple therapeutics here for COVID, I think is case in point for that. So with all the capital out there looking for a home, again, I'm quite optimistic. And I think from an M&A perspective, fundamentally, the buyers are out there looking for the right assets. So I think all systems go for next year from my perspective.
Awesome. Rachael, last but not least.
Yes. So I agree with both Catherine and Anurag. I think 2022 is going to have a little tampered down on the capital market side from the beginning of 2021, but better than I think we've seen here in the third and fourth quarter. I do think we'll see an uptick in the M&A, and I too am really excited about the new technologies, and I think at the end of the day that's going to continue to drive investments into the biotech space.
Awesome. So just to sum it up, I don't think it's a this time it's different. I think it's a this time it's more mature. We have more scientific advances, and that's what's powering this continued momentum. And there are more investors with more capital that will continue to keep us moving. And so those are the two trends that makes it different this time. And that's maybe what I high level took away from our discussion. So thank you all. We are out of time. I appreciate all three of you as well as all the attendees from joining. As a reminder, a link to the recording will be sent via email to each participant who signed up. And all of you can visit Locust Walk's website to download our Q3 market conditions report. We look forward to seeing all of you in person, hopefully very soon. So thank you very much.